Hello and welcome to this video. In this video, we're going to be talking about what taxes you should be aware of if you've just started out in business. Now, starting your own business is one of the most fulfilling things you can ever do. Trust me, I've been there, done that, and I know a lot of clients and friends who have done exactly the same. And as fulfilling as it is, and the amount of benefit you're going to get from it, there's also some pitfalls you need to be aware of. And in this video, we're going to be talking about the world of taxes to make sure that you are in control of them. Now, coming from an accountant, as long as you make sure you are on top of your tax in terms of you know what they relate to and when the deadlines are, then you're going to be in a real good shape. So sit back and relax, as this video will teach you how to make sure that you're prepared for the world of business and, more importantly, and crucially, the world of taxes. Let's get straight into it. Hello, my name is Aaron Patrick. I'm a chartered accountant, a certified UK trainer, that QuickBooks Chap on the internet, and head of accounts here at Boffix. Now, in today's video, we're going to be making sure that you are on top of those taxes. And we're going to start from the very beginning of if you want to start out as business and go through more complex taxes as we go along. Most of you out there will be thinking about going into this as a sole trader or going in there and completing what's known as a self-assessment. Now, if you think about it, if you've ever come from the world of work, it's really straightforward, isn't it? From a taxes point of view, HMRC know everything that you earn because you get a pay slip each month and they get to take all those lovely taxes off you right there and then. Now, if they're taking them all and taking into account from via payroll, well, you don't have that luxury if you are self-employed. There's no pay slip for you. There's no opportunity for you to declare how much you are earning. So what happens then is you have to declare your earnings on an annual basis. And this is what's called a self-assessment tax return, or what's otherwise known as an income tax return. Now, if you're going in business, then you trigger the requirement to actually have to complete one of these on an annual basis. And there's two key dates for you to know. The first very key date is the end of a tax year. Well, that's the 5th of April. Triggering a brand new tax year comes to the second most important date, and that is the 31st of January. So let's think about what those dates relate to. First of all, if you've started a business, then the next January, well, that's going to be your period end for the first of your tax years. That means that you have a chunk of income that needs to be reported on a tax return. And why did I say 31st of January? Well, that's the deadline that that tax return has to be completed, and also the deadline to make any payments due on it as well. So if you're ringing those bells on the 1st of January and you're thinking to yourself, you know what, this is my year to start my own business, and you start it on the actual 1st of January, well, then you've got to report from the 1st of January to the 5th of April on that first tax return. And you'll have until the 31st of January to make sure that tax return is completed. So your first big part of tax you need to know about is the world of self-assessment. And it's relatively straightforward to get your head around. It's basically how much income that business has generated, less any expenses the business generated, equals profits. And those profits form part of your self-assessment tax return. Now, you can't just submit your business profits in the tax return itself. You have to look at everything that you personally have earned in that year. So let's say that you have a part-time job, that will need to go on your tax return. If you rent property out, the income and rental income will have to go on there as well. And if you have stocks and shares and things like that, then there's a consideration for that as well. Basically, a tax year needs to contain all of the income you've earned, all put on the tax return, and it's that final profitable figure that you've made in a tax year which will determine how much tax you have to pay. So tax number one is about self-assessment, and you need to be making sure that you know that the 5th of April is the final day of a tax year. Therefore, there's going to be a requirement for you to complete a tax return, and you need to make sure you complete that tax return by the 31st of January. Now, the next tax is a tax that may or may not affect you in business, and it's called VAT, or value added tax. Now, when you first start in business, it's not compulsory to be VAT registered. In fact, you only have to be compulsorily VAT registered when you earn, and that's your total turnover in a 365-day period, more than £85,000 to £87,000. Now that figure changes on an annual basis, so do make sure you're looking at what the figure relates to in your period, but you do need to be making sure that you're keeping on top of what you've earned in a rolling 365 days. Because if you go over that figure, then you don't have a choice, you are compulsorily needed to become VAT registered. But what does VAT registration actually mean? Well, basically it means that you are then starting to have to collect VAT on the items you sell. So if you've been selling something for £100, then you have to add VAT onto it. So that means you have to sell it for £120. That £20 of extra VAT isn't yours. That £20 is collected on behalf of the government and paid over to them, normally on a quarterly basis. Now, it's not all doomed by the fact that you have to then increase your prices and you have to be more careful about how competitive you are. There is also a benefit to being VAT registered, and that's the fact that as a VAT registered business, you will have the opportunity to claim back any VAT that you've suffered. So if you've got telephone bills, or if you've got accountancy bills, or whatever the element that you have that has VAT on, well, you can collect the VAT you've suffered and offset it against your actual VAT return. So the amount you pay on a quarterly basis is what you've collected, less what you've suffered, and you only pay the difference. And if you manage to actually go into a position where you've only collected X and you've suffered Y and Y is bigger, then you actually get a refund each and every month or quarter. So VAT in certain circumstances can actually be taxes for good and become an opportunity for you to actually get some nice little refund each and every month or quarter. So, most important thing to know about VAT, it's not compulsory at the beginning, only when you get to the threshold. Once you hit that threshold, you have to become VAT registered, and there's some really nasty penalties and fines if you hit that threshold properly and you don't become VAT registered. And also don't forget that you have the opportunity to become VAT registered before you hit that threshold, and in some circumstances it can actually be a massive benefit for you. Keep an eye out on the channel on here, because we'll be doing some more videos on VAT in the not too distant future. Tax number 3 is payroll taxes. Now, payroll taxes, or PAYE, pay as you earn, is a tax when you employ individuals to work on your behalf. Now, when we think back to the beginning of the video, when we talked about that you were potentially working, then remember how you used to get a pay slip? Well, basically that pay slip is generated by PAYE, and if you employ people, then you have to take that tax off them. You have to then pay it over to HMRC. Also, depending on your business structure, as in if you're a sole trader or a limited company, then it might even be worth you going on the payroll and getting a pay slip each and every month as well. And just to clarify, that's for a limited company and not a sole trader. Now, these taxes for PAYE are very, very complicated. Basically means that how much your employees earned and their personal circumstances can dictate how much tax needs to be taken off. But in a nutshell, when you pay your employee, you pay them net of any taxes that are due, and then you personally take that taxes, put it into a pot and pay it over on a month-by-month basis. So there we have it, payroll taxes, a tax for you to be aware of if you're ever going to employ someone to work on your business. Tax number 4, very straightforward. It's called capital gains taxes, and it's probably the tax you're going to have the least amount of exposure to. But effectively, if you buy and sell something of a big value, then there's a potential of capital gains. More likely than not, it's going to come down to if you buy and sell a second property. The first property you always get a relief for, and no capital gains is related to it. But if you buy and sell a second property, then that's when it's going to become important. The other part of the capital gains can come into play is if you sell your business. If you sell your business, then there's the potential of a capital gains tax there as well. And that is something that you just need to make sure you get the right advice on, because failing to be able to declare that and not being able to prepare for it properly can be catastrophical in terms of how much tax you have to end up paying. And then the final tax to be aware of is that if you decide that your business should be a limited company, and there's a lot of very good reasons for that, then if you become a limited company, then you also have to contend with a tax called corporation tax. Now, corporation tax is kind of similar to that income tax idea, where it's all based on the profits that your business makes, so the income less the expenditure equals profits. But instead of having to worry about that 31st of January and that stable 31st of January deadline, the deadline will be based on your business actual year end, which you can decide what that year end is going to be, and then you have 9 months after that period to actually make the payment and declare the corporation tax return. Do remember though, if you have corporation tax return to worry about, i.e. you're a limited company, then there's a very, very strong possibility you still have a personal tax return to worry about as well. So it's not a surefire way of getting rid of that 31st of January deadline. More than likely it means that you have two deadlines to worry about, 31st of January for any personal elements, and then whatever your year end plus 9 months for your business to worry about their corporation tax return. And that's it. That is, in a nutshell, all the taxes. Now, each and every one of these taxes we've gone through today, we do in more detail either on this channel or on our sister channel, Aaron Patrick, the QuickBooks Chap. But if you need any more advice on this, don't forget to use the comment section below to ask us some questions. We're always doing Q&A videos and things like that, or we just reply directly to the actual question itself. And if you're still stuck, don't forget to use the link tree below, book some time with one of the experts here at Boffix. We are an accountancy practice designed for you in mind, making sure that we make sure that your business doesn't just survive, but thrives. And in times like this, that's exactly what you need. Don't forget to like, subscribe and all that jazz, because the more people that see this video, the more people that can be aware of what taxes are available to their business, and hopefully means they have less penalties to pay for. As I said, my name's Aaron Patrick. This video has been an absolute pleasure, and I'm sure I'll see you in the next video. Bye for now.